Jim Cramer outlines a positive investment game plan, buoyed by favorable trade relations with China and strong stock performances, particularly in the tech sector with companies like Nvidia showing substantial gains. He maintains a bullish stance on Visa and Mastercard, suggesting the market remains on an upward trajectory barring any new trade or economic concerns. Cramer encourages viewers to reach out for further insights through social media as he navigates these investment strategies.
Because we all know already, you and I, that we have way too much debt in the country. I'm not sure it will even matter, even as it should. But when it comes to business fundamentals, it's going to dazzle something that's going to happen Sunday night. And we got to talk about that. Even though I have to, I don't want to glaze over this Moody's downgrade. You know how we are. We tend to focus on what's going to happen next. And what's going to happen next is that Jensen Huang is going to give the ComputEx keynote speech, and it's going to come Sunday night. Now, I'm hearing there's going to be some dazzling new products and ideas. This speech will be online, streamed at 11 p.m. Eastern. Now, I can't figure out whether to watch it live or the moment I get up, but I won't dare to come to work without knowing what Jensen is saying. Now, we know Nvidia stock rallied 16% this week and is now safely back above the $3 trillion in market cap number. That's the beneficiary of a huge bevy of orders from the Gulf monarchies. By the way, it turns out they have a lot more core weave than we thought, and that stock took off today. Now, I wouldn't be surprised if Nvidia has more room to run, particularly because there are a lot of people who felt that it should never have been at $3 trillion in the first place, and they've been proven wrong. Next up, analyst meetings are up from very dry affairs that are informational but not actionable. That is not the case, though, when J.P. Morgan, the largest bank, speaks on Monday. Their analyst meeting moves, well, I'll tell you, it moves stocks, especially when CEO Jamie Dimon gives his somewhat jaundiced view of the world because, well, he's somewhat jaundiced. He may be a tad saturnine, too, while I'm at it. Monday also is the first day when Capital One, the credit card bank, trades as one with Discover Financial as the deal is now closed. Now, I've been telling people, members of my CNBC Investing Club, that Capital One is my favorite stock right now in the charitable trust, even as it just gained almost 20 points this month alone. I think the move is far from over. I expect number bumps and analyst upgrades. You've got to learn the Capital One story. Now, not that long ago, we dropped in on a monster Home Depot store management meeting in Vegas, where we heard about some great ideas for spring gardening season, which, by the way, kicks into overdrive this weekend. Unfortunately, these big weeks for lawn and garden have been overshadowed by stubbornly high interest rates and no rate cuts from the Fed, not to mention tariff worries. Now, I've watched this stock since it came public, and there are plenty of times when Home Depot doesn't actually march to the tune of interest rates, but instead is levered to repair and renovation. As so many people are stuck in their homes, unwilling to trade up, because that would force them to give up that low mortgage rate that they may have gotten during the COVID period. Now, we own the desk spot for the Charitable Trust, and while I'm not expecting a blowout by any means, I have to say I like it long term, and it's down 2% for the year, well off its highs. By the way, Lowe's is attractive, too. They report Wednesday morning. Both are excellent operators, although Home Depot is more about professionals, and Lowe's has more of a do-it-yourself customer base. Home Depot stock is a great one to own because, like Walmart, these guys have the scale to cope with the tariffs that are going to be put on so many foreign-made goods that they sell at Home Depot. The little guys, we know they don't have that kind of flexibility. Hey, one thing is for certain, nobody cares for the home builders. This group's been down so long, it almost looks up to me. Consider the case of Toll Brothers, the highest-end home builder. Toll reports on Tuesday evening. I think the numbers are going to be real darn good. I think the stock should be able to bounce. The chart looks terrific, but the company will most likely have to be restrained with its guidance because there's still a pervasive sense of negativity out there. At 7 times earnings, though, I think you want to own this one, even if their forecast isn't a thing of beauty. Yes, I know when it's 7 times earnings, that means it probably will not have higher forecast, but maybe it's just time to pull the trigger on some. Now, the Charitable Trust also owns PaloAlto Networks, which reports Tuesday night. This stock is an odd habit of going down, just no matter how good the quarter is, and they're almost all good. So you might want to wait until after the report if you want to buy a cybersecurity company that has very high quality. Now, speaking of going down after a good quarter, the worst offender of all might be TJX, which oddly may be the best of the retailers right here. TJX, forever holding up the Charitable Trust, buys excess goods from merchants who need cash and then marks them up and sells them to you at what's still a huge discount. Now, I've gone twice this week to my TJ Maxx. I just looking for who knows what. I like to go there. I'm looking for bargains like you. How about a flyer? How about VF Corp? Now, listen to me. The apparel company fumbled last time. I get that. But CEO Bracken Darrell, you may remember him from Logitech, he's a great operator. I bet he's too competitive to let a second debacle happen. Might be worth taking a position and build it in any weakness. Finally, there's the most problematic of retailers of all right now, and that is Target. Now, this one's experienced a sharp downturn, totally out of step with the company and with the CEO, Brian Cornell. Target's been luckless, a victim of protests that hurt the business. Can you buy it now knowing that the stock sports a 4.5% yield? My fear is that Target reports an okay quarter, but then says it can't offer a forecast, at which point you're sitting on a dead waiter. Now, let's say you put a gun to my head and ask me whether you should buy it or sell it. I'd say, what the heck are you doing with a gun to my head? It's too hard. Also, Wednesday, we hear from Medtronic, and I like this medical device powerhouse, but the stock's been inconsistent, even as the numbers tend to be pretty darn strong. That means it's hard to game. Another one I got to say, wait and see. Now, that's not how I feel about Snowflake, though. The data storage and analytics company with a business that is on fire. Last quarter was terrific. I think this one will be too. Oh, and don't forget, Jeff, Marks, and I, well, we've got our investment meeting. We do our investment club meeting once a month, and we have a new idea. I hope you tune in. We're tackling a lot of stuff you should join before the monthly meeting. Now, if you're looking for an apparel company that keeps delivering, I suggest you look no further than Ralph Lauren, which is captained by Patrice Louvet, a man with both excellent taste and the intelligence to tell the story to every age group. Ralph Lauren reports Thursday morning. I buy this one ahead of the quarter, too. Now, we got a bunch of controversial ones coming on Thursday. Intuit is a stock that's been all over the map, but the company's a godsend for small business owners. The stock's expensive here. I think it's worth it. You want a company that's in a suddenly red-hot segment of the shoe business? Look at Deckers. Think about this. Think about what's happened in the shoe business. First, we get Skechers gets a bid to go private. Huge win. Then we got this spectacular quarter from On Holdings. On top of that, Dick's Sporting Goods pays almost twice the price to acquire Foot Locker. Remarkable bid. So last time Deckers, which owns Hoka and Uggs, reported its first disappointing quarter in ages, and the stock was just clubbed. Hoka was incredibly strong, though. Uggs didn't have enough inventory, so there was no blowout, and the stock got crushed. These guys are excellent operators, though, so I don't think that will happen again. I'm inclined to be in favor of Deckers ahead of the quarter here. Now, we've been on a real rebound since post-Liberation Day meltdown back in the last first week of April, with tech leading the way after really taking it on the chin. I don't know if that will continue, as there's a dearth of news coming from tech, except for that Jensen keynote. A lot more retail next week. But here's the bottom line. Unless we get news of new hostilities in the trade war with China, I think this market's propensity will still be to go higher, even though we are overbought. And even with this late-night credit rating downgrade of the U.S. debt, which is very quizzical to me, I think we're containing the downside of the economy, and that means no recession, which tells me the negativity may be out of sync with the reality. That's often the best kind of market.